Okay guys, this is going to be a very quick video demonstrating two opposing options trades, a put trade and a call trade, and this is going to be on SPLG, okay? So this is going to be the lowest cost ETF that tracks the S&P 500 that I know of, and this is great if you want to learn how to trade options. You're going to use SPLG because it's approximately 10 times cheaper than SPY, which is the most liquid equity trading ETF on the stock market, the US stock market. So let's take a look here. The call and the put option, and I'm going to break down exactly what the strike price is, what our potential loss, our max gain is, etc. And I'm going to show you both of these trades. So let's start number one. Let's start off here with the call. Okay, so if we think that the stock is going to go up, we would buy a call option, and we are going to set up our indicator for our profit loss or risk reward. And we're going to base that off certain things. So you can see the stock is trading here. And if we break out of this fair value gap or this gap fill, that's where I personally would want to take my call option. Now, I have to define where I want to get out of this trade, both for a profit and for a loss. And so buying this trade right now, market is closed right now, but if I were to buy this trade right now, it would cost me, the ask is $55. Okay, that's for one options contract that expires tomorrow. So this is going to be a 0 days to expiration, 0 DTE. So it's $55 to buy this. And I've put my limit sell order right below this other gap fill. So if this stock climbs tomorrow, breaks through this, and touches here, which is likely to happen, right? This is the first level of resistance. My $55 contract would gain approximately $42.50, which would be a return on investment of 77%. So I'm putting in $55, and I've dedicated that I will sell this contract right here for a profit of around $42.50. But there's a but here. If this continues to trend upward and I decide I don't want to set a limit order, I could set a different limit order up here somewhere in this value gap. And if we did it up here, that'd be an $83 return on investment, which is 150% return on that initial $55 trade. So we showed you the potential upside for this trade. If we bought just one contract, we bought it for $55. I would sell it here if the stock price got here at a $42.50 price improvement. Or if the trend was just driving upward, I would probably hold it until somewhere around the top of this gap for an $83 price improvement. So my profit margin is approximately 77% to 150%, depending on where I want to put that limit sell order. So I've defined how much money I want to make in this trade, but I also have to define how much money I'm willing to lose in this trade. And again, I'm going to be going off technical indicators here. So if the price of this does break through and my contract is purchased, but then the trade starts going against me, I want to get out of this trade before I hit this level of resistance here, which is this kind of this big candlestick here. Because once we get here, the price is just going to continue down and down and down, and my contract is going to get devalued. So you want to get out while you can. And so I've set my stop loss to around $29.75. So what I'm saying here is I'm going to pay $55 for this contract. And in doing so, I'm going to risk about $30 to where the trade will close at a negative. So I'm risking about 54% of what I've put in. And in doing so, my upside is 77% to 150%, give or take. So my risk reward is about 1.39 to 2.69, depending on where I sell the contract. Okay. Now, keep in mind, this is not a lot of money, right? $55 to gain 42 or to gain 83. But if you buy 10 of these contracts per se, that means you've put in $550 to make $420 or to make $830. And so now you can see how this can be profitable. Okay. Now let's look at the put side. If we think the stock price is going down tomorrow, I'm going to wait for confirmation. Okay, so I want to see this kind of trend downward first a little bit, and I'm waiting until it meets the lows of pre-market and breaks through those. And once we break through those, I want to buy the put contract, which for us, this put contract is going to cost $80. And if we buy that put contract and the price continues down, 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 I want to sell at some area of previous support or resistance. And so here would be our first level of resistance. And if we were to sell that contract here, we'd have a profit of 46% on the $80. So that $80 would net us an extra $36.55 for a 46% return on investment. So we can also see if there is a ton of sell-off here. Maybe we don't want to sell here initially. We can sell way down here if we wanted to, because this is the only other area of resistance that we see down here. Sorry, I did that a little far. Maybe right there. And if we look at that, sorry, right there. If we did that, you can now see that our $80 trade would net us $107 or 134% return on investment. So depending on how long this trade's going to be, like this is a 0 days to expiration, so I'm probably not going to make that big of a move, but you can see that's really not that big of a move. It's a 3% move. This is only a 1% move, so the market has been fluctuating that much. That's not a problem for this volatility range. So what we're looking at is on this trade, I'm putting in $80. And I'm only risking about 20 of those dollars. If this trade goes against me, I'm out $20. But I stand to obtain a profit of $36.55. And so the easiest way for most people to look at this is I'm putting in $80. I'm going to risk 25% of that $80. I'm risking 25% to make about 50%. And so that's a risk reward of around 2.0 to 1. And in the call contract, for just this specific trade and what the market looks like tomorrow, I'm going to put in $55 and I'm risking about 50% of that for about a 70% to 150% upside. So you can see you're always risking less than you're willing to take in profit. You're always risking less than you're willing to take in profit. And the reason being is that if this trade does go against you, as long as your risk reward is like 1.5 to 1, you can lose 2 trades in a row, and as long as you make that third trade, you're still profitable, or at least break even. And the beauty of this system is that typically you're not going to buy one contract, right? In this case, $80, I would probably buy like, let's say 10 contracts of this, or for this 550, 10 to 20 contracts. And what you can do is you can have half of them sell right here at this profit, and then the other half sells somewhere in here. And so once that first half sells, this trade is technically going to be like break even. And so now you have no money that you could possibly lose, and then it's all upside. And so you can do the same down here as well. If you wanted to buy like 10 of these, so your initial investment is $800, and say you want to sell some of those contracts here for a profit, but then you want to hold on to the rest to gain that additional profit way down here, you certainly can do that. Okay, so that's the beauty of owning multiple contracts. That's typically what I do, so that you can have a quote-unquote risk-free trade by selling some off initially to get rid of this purchase price. So then your purchase price becomes, purchase price then becomes 0. Okay, so that's all I wanted to talk about, was just 2 sort of options plays that I'm looking at for tomorrow. Just depending on if I get up and decide to do them. And that's basically it. In the next video, I'll probably show you how to set up one of these first trigger OCO trades, because these are totally automated. Like, I'm not going to sit here and watch the market move. I'm going to set this trade in the morning. I'm going to define my loss, and I'm going to define my profit area, and the trade will either go the direction I want it to, or the trade will not. Okay, so there's no emotion defined in here. I'm going to let the algorithm do what it does. It's going to place the order when I ask it to, and it will fill or sell where I ask it to. and that's for intraday only. I want to make that very clear. These numbers only work for intraday trading, okay? So thanks for watching. Follow. If this doesn't make sense, I'm going to break a lot of this down in future videos, and we'll see you on the next video.